welcome to ValueVest Daily. January 2026 was one of those months that just gives you market whiplash. On the surface, the headlines were all saying, hey, stocks are up, it's a great start. But if you dug just a little deeper, a truly historic crash was unfolding in one corner of the market, and it sent some serious shockwaves through the system. This wasn't just your everyday volatility, this was something different. So today, we're going to untangle these completely crossed signals and figure out what it all means for the year ahead. And this slide really captures that split personality perfectly. On one hand, you've got the S&P 500, the big benchmark for the whole market, finishing in the green, a solid win, right? But then, on the other hand, you have gold and silver, the assets people buy when they're scared, getting absolutely hammered in a sell-off we haven't seen in decades. So how can the market be so bullish and in a total panic at the exact same time? Well, that's the puzzle we're going to solve together today. All right, just a quick but really important note before we properly jump in. Everything we're talking about today is for informational and educational purposes only. This is not financial or tax advice, so please always do your own research and chat with a professional. So here's our game plan. We're going to start by unpacking those mixed signals from January. Then we'll dive right into the data to see what really happened with that metals crash. From there, we'll follow the money and talk about something called the Great Value Rotation. Put it all into historical context, and then wrap everything up with a clear playbook for 2026. Okay, let's get into our first section, January's contradictory signals. On the surface, the story seems so simple. The market went up, but that one headline number was hiding a much, much more dramatic story underneath. And here's that number. The S&P 500 finished the month up 1.4%. That's a pretty solid positive start to the year. But please, don't let that quiet little number fool you. It completely masks the absolute chaos that was bubbling up just below the surface. See, the really crucial point here is how the month ended. After a pretty strong run, the market just stumbled across the finish line, closing down 3 days in a row. Now, it wasn't a crash, not even close, not a major correction, but it was this persistent bleed that signaled some real weakness and a lot of profit-taking. It's kind of like a marathon runner who's on a record pace and then suddenly starts to limp in the final mile. It just makes you wonder, what changed? What spooked everybody right at the end? So let's get into the raw data and see how this all builds a story of a market that's really in transition. To understand that end-of-month weakness, we have to look away from the S&P 500 for a minute and turn our attention to the assets that were truly making the headlines. And here it is. This is the epicenter of the earthquake. On the very last trading day of the month, January 30th, gold didn't just drop, it absolutely plummeted. An 11.4% fall in a single day for gold is, well, it's almost unheard of. This was the worst single-day performance for the metal since the 1980s. Folks, this wasn't just selling, this was a stampede for the exits. Something big had to have triggered this. And this just brilliantly illustrates the sheer panic. If gold's drop was an earthquake, silver's was the tsunami that came right after it. A 31.4% collapse. This was silver's second worst day in its entire history. When you see moves of this magnitude and assets that are supposed to be your portfolio's insurance policy, you know a fundamental assumption in the market has just been completely shattered. Now, this table really puts it all into perspective. Look at the S&P 500. Looks pretty calm, right? Then you see gold and silver in an absolute nosedive. But check out the Russell 2000. That's the small cap index. It was up 5% for the month. It basically just shrugged off the entire metals crash. This shows a really clear split. Money wasn't just leaving metals, it was rotating into a very specific part of the stock market. So what in the world caused this unprecedented meltdown? What could possibly trigger a historic crash in gold and silver while small-cap stocks were actually rallying at the same time? Well, the answer isn't a single event, but a rapid cascade of them. This is the key question, right here. For months, even years, a certain kind of trade had become incredibly popular, super profitable. But on January 30th, it was like the music stopped, and everyone rushed for the exit at the exact same moment. It was a classic unwind, just on a scale we haven't seen in decades. So this perfect storm really had 4 parts. First, metals were already what we call overbought. Just think of a bubble that's waiting to pop. 2, the catalyst. A new Fed chair nominee was announced, and this person was seen as a hawk, someone who would prioritize a strong dollar.
This instantly eased fears that the government would devalue the currency. 3, the dollar immediately surged. And 4, with the main reason to own gold suddenly gone, everyone who had piled into this debasement trade rushed to sell all at once.
So let's quickly define this really crucial term. A debasement trade is essentially a bet against the US dollar. See, investors who were afraid the government would print too much money and sink the currency's value, well, they'd buy hard assets like gold and silver as a hedge. And for a long time, that was a fantastic strategy. But the new Fed chair nomination completely flipped that script overnight. All of a sudden, the whole reason for holding gold and silver just vanished. And all those speculators who had piled in had to sell right then, all at the same time. And this brings us to what I think is the most important part of our analysis for you as an investor. All that money that came rushing out of gold and silver, we're talking billions of dollars, it had to go somewhere. This chaos didn't just destroy value, it actually created a massive opportunity, and it sparked a major rotation into overlooked and undervalued parts of the market. This chart shows you exactly where the money went. It fled from gold, it mostly skipped right over the big S&P 500 companies, and it poured directly into small caps. And that, my friends, is a classic risk-on signal. Investors weren't running for cover, they were actively hunting for growth. And we can get even more specific. This rotation wasn't just into small caps broadly, it was into specific value sectors. I mean, just look at the valuations here. Financials, banks and such, trading at a low 10 to 14 times earnings. Industrials at 15 to 20 times earnings. These are the sectors that benefit from a strong economy and a stable or strengthening dollar, the exact opposite of the environment that favors gold. Investors were making a crystal clear pivot from betting on fear to betting on fundamental economic strength. Now, a volatile start to the year like this can be, well, unsettling. A historic crash in one asset class while another one rallies can feel chaotic, unpredictable. But what does history tell us about a month like this, one that ultimately ended in positive territory for the broader market? Well, there's this old Wall Street saying, as goes January, so goes the year. It's called the January barometer. And while, it's not foolproof, it has a surprisingly strong track record. As you can see, when January is down significantly, like in 2008 or 2022, the rest of the year often struggles. But when January is positive, like the 1.4% gain we just saw, history shows the market finishes the year higher a staggering 86% of the time, with average returns around 16%. It's a really powerful bullish signal hiding amongst all the noise. As the saying goes, history doesn't repeat, but it often rhymes. And this pattern of rotation from froth to value is a classic rhyme we see in the market. But it also raises a really interesting contrarian question for us. With everyone fleeing metals, is there now an opportunity hiding in the wreckage? After a huge panic sell-off like that, the smart question is always, did the market overreact? Are gold and silver fundamentally broken, or was this just a fear-driven fire sale? With technical indicators now showing these assets are deeply oversold, it's definitely worth looking for a potential rebound. And when we look, we actually see some pretty interesting numbers. The companies that actually mine the gold, which you can track with the GDX ETF, are now trading at reasonable PE ratios of 15 to 18x. A high-quality, low-cost producer like Barrick Gold is sitting at about 16 times earnings. So if you believe the long-term case for gold is still intact, driven by things like central bank buying and as a long-term store of value, then this crash might just be the entry point you were waiting for. It's a contrarian play for sure, but those are often the most profitable ones. Okay, we've covered a lot of ground. A contradictory market, a historic crash, a great rotation, and the historical context. Now let's pull it all together and distill it down into a clear, actionable playbook for the rest of 2026. Looking ahead, it's really a balancing act. The headwind? Market valuations, especially when measured by long-term metrics like the Shiller PE, are historically pretty high. But the tailwind is powerful. Corporate earnings are projected to grow over 14%. And we're seeing more than just big tech participating in the rally, which is always a sign of a healthier market. So here are the most important takeaways from January's complex market action. First, the clear trend is the value rotation. Keep your focus on those sectors that are benefiting, like small caps, financials, and industrials. Second, keep those oversold commodities on your watch list for a potential contrarian rebound. Third, don't forget the January barometer. History suggests the odds are in favor of a positive year. And finally, remember that strong earnings growth is the engine that can power this market higher, even with those high valuations. So, what's the bottom line? Well, balancing the risks and those powerful tailwinds from earnings growth, 2026 could actually deliver some pretty solid returns for the S&P 500, potentially in that 9 to 12% range.
January showed us it's probably going to be a volatile ride, but the fundamental picture looks positive.
And that leaves us with a final thought to guide your strategy for the rest of the year. The market has shown its hand, and this rotation into value sectors is underway. So the key question for you now is, where are you going to look for opportunity? Is it the momentum in small caps and financials, or that contrarian play in the beaten-down commodity space? Please subscribe, like, and share ValueVest Daily for daily learning opportunities before you put your money to work. And one more thing, please put in a comment if you want us to deep dive into any specific high-risk/reward opportunities.